Welcome to the Beehive, the podcast where we explore the latest trends, challenges, and strategies in the world of finance and corporate governance. I'm your host, William, and today's episode is all about leases. We'll cover some of the key lease concepts and highlight common issues, pitfalls, and best practices. Joining me today are Lord and Gliezel. First, we have Lord Gen Rilloraza, a lease accounting specialist. He'll share his insights and knowledge about the common trends regarding ASC 842 leases.
Hi, Will. Thanks for having me. I'm happy to be here and I'm excited to share my insights on leases.
Hi, Lord. We also have Gliezel David, a technical accounting director with years of experience assisting clients in figuring out lease peculiarities. It's nice to have you back, Lee.
Yeah, happy to be back in Beehive Will and cover a new technical accounting topic.
Yeah, together, Lord and Gliezel will discuss the current trends and hot topics on leases. We'll explore how companies are adopting the new lease standard, which became effective in recent years, and what areas need further fine-tuning. Let's dive in. To kick things off, could you give us an overview of the common pitfalls or challenges regarding leases, Lord?
Sure, Will. We can discuss a few things, such as your complex contract structures, since not all contracts are simple and straightforward, and they may include other components such as your non-lease components, your variable lease payments, and your lease incentives. We can also cover embedded leases. We can also talk about lease modification and impairment assessment.
Yeah, I want to cover that one by one. Let's start with lease and non-lease components. Why do we need to identify which is which? And, how do we do it?
Yeah, so basically a lease component is essentially a piece of the puzzle that makes up the overall lease arrangement. And it's directly tied to the asset, meaning they are capitalized, while a non-lease component is a separate element of the contract, meaning they are not directly related to the asset and they are generally expensed when incurred. So these non-lease components are additional services or additional rights like providing a driver for a leased truck or common area maintenance or training the lessee's personnel on how to operate the leased asset. So by accurately identifying the lease components, lessees can ensure that expenses are recognized in the correct period. So as mentioned, lease components are capitalized and amortized over the lease term, while non-lease components are expensed as incurred. Accurate classification of lease components is essential, not just for compliance with accounting standards, but also for accurate financial reporting.
So how do you exactly separate or how do you exactly handle this separation?
Well, ASC 842 requires us to allocate the total contract consideration between the lease and the non-lease components based on their relative standalone prices. Now, this can get tricky, but it's an important part of compliance. Now, the good thing is the standard also offers a practical expedient for lessees. So if separating lease and non-lease components seems too complex, we can actually elect to combine them into one lease component. Now, this means we would account for the entire payment as part of the lease. It's worth noting, however, that while this simplifies the process, it can also result in a higher lease liability on the balance sheet since we would include non-lease payments as part of the lease component.
How will this you've mentioned the practical expedite, how would it affect I think that was called ROU, right?
Yes, yeah.
The ROU asset and, the lease liability balances.
Well, if you opt for the practical expedient and combine the lease and the non-lease components, you'll have a larger lease liability and a larger ROU asset on your balance sheet. Now, this can impact key financial metrics like your debt-to-equity ratio, since you'll be recognizing a higher amount for your lease liability. And this may influence how investors view your company's financial health.
Got it. Well, I'd like to go back to our payment regarding lease payments. So you've covered lease and non-lease, but are there other complexities we need to consider in terms of lease payments?
Yeah, that's a great question. It's definitely a challenge if the arrangement contains lease payments that vary depending on certain factors after the commencement date, such as your CPIs or your consumer price indices, or based on a certain level of sales. Now, since the payment amount could change, variable lease payments could greatly impact the measurement of your ROU asset and your lease liability and affect the lease expense recognized throughout the lease term.
So if these amounts could change depending on certain factors, how would they be measured?
Well, companies actually tend to miss this out sometimes. Payments based on CPI are measured using the index or rate prevailing at lease commencement with no assumption of future fluctuations. So variable lease payments other than those that depend on an index or a rate should not be included in the initial measurement of lease payments unless those are in substance fixed lease payments.
Yeah, I think I'm starting to understand, but could you give me an example of variable payments in substance fixed lease payments? Yeah.
Yeah, so if a lease agreement says the rent will go up in year 6 based on how much prices have risen in the past 5 years, but it can't go less than 5%, then the 5% increase is considered a fixed payment. It's like saying the rent will definitely go up by 5% no matter what. So it's really not a surprise. Therefore, this variable payment would be included in the measurement of the lease liability.
And you've mentioned that companies tend to miss out on this.
Yes, yes.
Is there a big effect when companies tend to miss out on this measurement?
Well, if companies miss this out, then there would be not misrepresentation, or the balances in the balance sheet would be inaccurate. So the measurement for your lease liability would not be accurate. The measurement of your ROU asset would not be accurate, and therefore it would have a domino effect since the expenses that would be recognized later on would also be inaccurate.
So a small thing could generate into a bigger problem. All right. Well, thanks for sharing, Lord. A while ago, we reviewed several items that the lessee? Lessee, that's nice. The lessee should pay. Now let's move on to the benefits or incentives. I agree that this is one of the complex areas of lease accounting, right?
I also agree, Will. So lease incentives might include cash payments, a rent-free period, or contributions to fit out costs of the leased property. But let's focus on TIAs, or your tenant improvement allowances. So the accounting treatment for TIAs hinges on a crucial distinction: whether the improvements made using the allowance constitute a lessee asset or a lessor asset. So improvements primarily benefiting the lessee during the lease term, such as your tenant-specific build-outs, partitions, fixtures, finishes, these are considered lessee assets. So in this case, the TIA represents a lease incentive. On the other hand, improvements benefiting the lessor beyond the lease term, such as your building-wide upgrades to the heating, ventilation, and air conditioning system or HVAC system, or structural enhancements, these are considered lessor assets. So here, the TIA is treated as a reduction of prepaid rent.
So how will this difference in treatment be reflected in the company's financials?
If the TIA is treated as a lease incentive, the lessee estimates the timing and amount of TIA reimbursements and includes them as a reduction of lease payments when initially measuring the lease liability and the ROU asset. However, if the TIA benefits the lessor beyond the lease term, the lessee's payment for lessor asset improvement is considered prepaid rent, and the TIA recovered or received from the lessor reduces the prepaid balance.
Gotcha. Thanks, Lord, for a very comprehensive discussion covering the complexities of a given lease contract. You've mentioned before were you a professor in accounting? Yeah. What did you specifically teach?
I taught financial accounting and reporting and auditing problems.
Amazing. And how many years did you do that?
Almost 8 years.
Really?
Yeah.
So you've been a professor longer than you've been working here at Scrub?
Yes. Yeah.
That's really nice. All right, now let's move on to the other challenges. Earlier, embedded leases were mentioned. Glee, I think this is where you should step in. Can you tell us more about this?
So for embedded leases, so it's not new actually. So with the ASC 840, the previous standard, it's actually existing. But with the new ASC 842 requiring capitalizing the leases into the books and recording it as now assets, as an ROU assets and lease liability, there's now a heightened requirement for entities to assess and check and then capitalize this in the books. Thus, this is one of the common items being missed out, as this might not seem to be a straightforward lease agreement. So there are leases embedded within larger arrangements or contracts not explicitly tagged as leases.
And can you provide sample agreements where a lease agreement might exist but is not explicit in the contract?
So let's take a step back. So going back to the definition of a lease, so it's a right to control an identified asset within a period of time in exchange for considerations. So there are contracts where there might be an identified asset but not explicitly tagged as a lease because probably these assets are just needed to supplement other arrangement for that arrangement to be executed. So some examples are, say, advertising agreement. So the agreement is to provide a service to advertise, but during the process, the advertising company will provide you, say, a billboard or a signage. So that's an identified asset. Another one, construction contracts. So constructing a building, but in the process, they will provide you a crane or equipment for you to lease out. Another one, satellite services with set-top boxes, or medical consumables with medical equipment or medical devices included in the contracts. And the list goes on.
Oh, so how can companies avoid overlooking these things and account properly for embedded leases?
Mhm. Definitely putting processes and controls is a must. So for new contracts, the entities should have a sort of a checklist for them to identify if there are possible embedded leases or assets within a larger agreement. Another one is to conduct a regular embedded lease search. So, say on a quarterly, semi-annual, and annual basis, companies can do a vendor analysis, check the nature of the transactions that are recurring by nature and seem to be a lease. And then from there, they can further review and check if the said transactions contains a lease. And lastly, another option is management to conduct a physical inspection. So in the area, if they'll see an asset, they need to check, is that asset recorded under PPE or under an already capitalized lease asset? If not, then probably it's an unrecorded asset because it's an embedded lease.
I I try to imagine what if these are not properly assessed? There will be a misstatement on the company's financial statement. Is that right?
Yes, and this might be significant as we are capitalizing the amount based on the lease term and other considerations such as lease extension, termination, and renewal.
All right. Moving on with our discussion, I want to talk about now lease modifications. What are the complexities that arise from here?
So, if a lease modification is already explicitly stated in the agreement, it's a matter of assessing whether the change is substantial enough to trigger a modification accounting or if the terms will lead to them being accounted for as a separate contract. Sometimes, there are potential events that might impact the existing agreement. So, say, they don't have a new amended agreement, but because of the terms from the existing agreement, there might need to do a reassessment because of some of changes in circumstances. So, for example, there is a change in assumption or circumstances, like a change in certainty regarding exercising an option to extend, terminate, or renew an agreement, or even a definite plan to purchase an existing asset, identified asset.
Are all lease modifications accounted for in the same way?
Well, for modification accounting, say the one that we've already identified that it will be accounted for under modification accounting, it's still there are still differences in the calculation. Say modifications may or may not require revisiting lease classification or discount rate. Well, changes in the discount rate are seldom since this will be triggered if there's a substantial change in the lease term or a significant change in economic circumstances.
So I'm trying to understand this. Is there also a change if there's, for example, a change in ownership? Say a lessee on the agreement is changed. Say, or maybe say a business with an existing lease agreement was acquired.
Yes, yes. Thanks for bringing that up. Well, in previous years, there are lots of business acquisition. So definitely from the business acquisition, the lessee will be changed because of the change in business ownership. So per business acquisition accounting, the assets are required to be accounted for at fair value at the time of acquisition. So the related leases will now be remeasured at that date. And well, in essence, for the acquiring company, they must apply their accounting policies and procedures to the acquired leases, treating them as if they're new leases.
Great. Well, thank you for that, Glee. As I think we're nearing at the end now, let's cover the impairment assessment. What are your thoughts on this?
Well, as ASCH 42 now has the right of use assets, so it's same with the other assets that we need to assess their recoverability under ASC 360. So impairment can happen due to various factors such as economic downturn, changes in market conditions, and other events such as natural disasters. So it's important that management consider these things and these triggers for them to assess impairment and record the impairment as needed.
That's nice. Thank you, Glee. I think that's a really good way to wrap up our discussion. Do you guys have any final reminders?
Thank you as well for today, Will. So, although the new standards been effective for a few years now, challenges still arise as we continuously comply or adhere to with these standards. So, for this session, we only covered a limited topic. So it's critical and important to refer to the standard or consult it to the company's technical accountants.
Yeah, and just to add, management should also pay extra attention to areas that require judgments and estimates. We always emphasize judgments and estimates. So it will be helpful for them to have processes and controls that mitigate risks and capture items that must be updated regularly.
All right. Well, thank you so much. Well, there you have it, folks. We've covered a lot of ground on ASC 842 leases today. Thank you, Lord and Glee, for your insights. Remember, understanding ASC 842 is key to accurate financial reporting and steering clear of costly mistakes. Should you have any related concerns about this topic, feel free to reach out to us or to the technical accounting group to simplify issues on leases. Once again, thank you to our guests for sharing their insights and to our listeners for tuning in.